Well, I think what really happens is that, no, the culture is the same. And the culture is always going to be the same because the role of Wall Street and banking in general is to basically take investors and savers' money and intermediate it and put it out to people who want to borrow it. And that always means taking risk. What the aftermath of Lehman has done is it's actually made, I think, banks in many cases less risk-taking. It's making it a little bit harder for them to find profit, which is one of the reasons. I know they're making a lot of profit right now because of spreads, but they're really looking, and that's why they want the Volcker Rule repealed. They want to get more heavily back involved in trading because the loan books aren't growing quite as rapidly as one would think given the size of the growth in nominal GDP in the United States. But the risk has really gone out, I don't want to say underground, but it's gone to private hands. So a lot of the risk, I mean, you don't have the mortgage risk and you don't have that kind of a margin on margin and leverage on leverage that you had back then. But what you do have today is that you do have collateralization of loans and CLOs, which is a huge market right now. And who's buying it, right? You have asset managers, you have hedge funds, you have private equity funds. A lot of firms, especially in the space in the high-tech area, they're not borrowers because they don't have the collateral that firms, banks understand, but the private equity market does.
Steve, I don't want to say this crisis will be like the last one. So many people have told me it's going to be different. But one thing I can see is that global debt is now $247 trillion US dollars.
Right.
$247 trillion. Sounds a big number. What does that mean? 318% debt to GDP the world has most. So the debt is way bigger than we were in 2007, 2008. Plus the fact you just said that the banks themselves are less risk takers now than they used to be, i.e. they don't have that proprietary market-making facilities as well. They cannot be the buffer, the absorbing of that debt or those products when they come to market when people need a little bit of liquidity as well. Those two things combined terrify me.
And they should. Because one of the things I was rambling to was that as a result of Dodd-Frank and a lot of the other rules that has occurred is that the liquidity in the marketplace is gone. So back in the days we were talking about when I started working, you know, when I was at Solomon in the early 80s, the investment banks on the firm would make markets, right?
We had to provide liquidity. That was our job, wasn't it?
Exactly, and these firms put up capital to support the desks to do that. That doesn't exist today. So what exists today is really a market by appointment. So if everyone starts going on one side, and obviously the bad side, everyone wants to start selling, who's on the buy side? Who's going to be take the bid? And in the fixed income markets, it's very clear in the United States, it's the Fed. The Fed is the liquidity of the fixed income markets. Now you move over to the equity markets, that's a much tougher answer because the Fed has no legal role to come in and buy equities. It would have to create it for itself by act of Congress and all that. Now, there's always tales that it calls up the Swiss National Bank and the BOJ and other central banks that can and do buy equities to step in. But
the
that's something.
PPS.
Yes.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.